VanEck, one of the
they're the ones that said gold could go to 189,000.
So they actually were talking about the M2 money supply. If the M2 money supply were fully backed by gold, the implied price of gold per ounce would be about 184,000.
Yeah,
that's in the United States.
Yeah,
but then if we take into account regions like India, Brazil, Russia, Middle Eastern, basically BRICS. Basically, if we just add BRICS into there, we're talking about 225,000 per ounce.
You know, Bank of America, their lead analyst, their lead precious metals analyst, just came out and said that they see, because of the gold silver ratio being so far askew, that they could see silver hitting $300 by the end of this year. And 309, I think, was the number.
The global money supply is creating the foundation for very high precious metals prices. If the USM2 money supply were fully backed by physical metal, the implied price of gold would be $184,000 per ounce. If we include BRICS nations' growing economic influence, this figure rises to $225,000 per ounce. Andy Schectman, a highly respected financial expert and precious metals authority, examines these monumental projections from major institutions, including VanEck. He also highlights a bold forecast from Bank of America's lead analyst, who anticipates that the severely skewed gold-to-silver ratio will inevitably correct itself. This massive technical snapback could easily propel silver prices to an astonishing $309 by the end of this year. The undeniable math behind the creation of infinite fiat currency guarantees a historic revaluation of tangible assets. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
VanEck, one of the...
they're the ones that said gold could go to 189,000.
So they actually were talking about the M2 money supply. If the M2 money supply were fully backed by gold, the implied price of gold per ounce would be about 184,000.
Yeah,
that's in the United States.
Yeah,
but then if we take into account regions like India, Brazil, Russia, Middle Eastern, basically BRICS. Basically, if we just add BRICS into there, we're talking about 225,000 per ounce. Based on the
they don't have a dog in the fight. I read that. It was from their emerging market bond team. I wanted to talk about two things. We'll take some questions after that. You know, the March delivery, it's under pressure. There's 81 million ounces roughly, or 16,250 contracts. That's the registered category right now, versus an open interest of 112,700. In other words, you have about 7 times the amount of contracts issued, 8 times the amount of contracts or issued as bars that could theoretically be delivered. That's not good, although they continued somehow to find a way to knock down open interest. Maybe
explain it to our listeners in literally baby terms.
Each contract is 5,000 ounces. Okay. And so right now there is 81.2 million ounces. You divide that by 5,000, you'll get 16,250 contracts. Those are bars that are backing the contracts.
Got it.
So
that's what they are available now.
If 16,250 contracts stood for delivery, it would eat all of the registered category. Now the eligible category, that's not counted. Those are bars that are held inside of all people don't want to sell.
Right. They could be yours. They could be mine.
Yes,
so that doesn't count.
No, they could. And it's funny. The COMEX says, well, up to 50% of the eligible category. So you got about, I think last I looked, 250 million ounces or so. So whatever. But it's not for sale. Anyways, the open interest right now with, what's the date today? The 8th or 9th?
Today's the 9th.
So we got 3 weeks left, 2.5 weeks left. There's 112,700 contracts open interest at 5,000 ounces a piece. That means they could
650 million, roughly, whatever the number comes out to be.
Yeah,
112.7 times
5,000.
Right. So that's roughly the number. That's what could, if they all stood for delivery, then we are basically, shit out of luck.
Well, the whole thing blows up. But we've already seen 6,615 contracts stand for delivery already, which is 33 million ounces.
So it's 563.5 million ounces.
But I want to talk about something that I find to be very, very, very interesting. And here's another way that the media co-conspires with the big banks to create or paint a narrative. So GLD last week saw $4.2 billion worth of gold leave the fund in a single week. And that's at all-time high prices nearly, right? So GLD just recorded the single largest weekly outflow in its 20-year history. Now, in the media, they will tell you that that shows people are moving, the outflows are leaving to find alternative assets, that they think the gold run is over. Yet, if you look at it, we've seen these massive outflows and the price is held rather stable, right? If you have that kind of volume leaving, you would think the prices would get blown up. What I am trying to say to you is that this is one way that I think the big money, the big money, is stealing from the ETF in essence to hide their intentions. And stealing is the wrong word. The authorized participants can create or redeem what they call baskets. And those baskets are 100,000 shares each. And in essence, what they do is they create or they go out and accumulate, purchase shares, create them themselves, and then they redeem them themselves through what's called share redemption and can take the metal out. And so when you see a large outflow, they will tell you that it's the big money repositioning, and it's the big money that is trying to find another place to put their money. You should
reallocation of assets.
Yeah, and instead, this is the APs, the authorized participants, which are the big banks, that are taking gold out and silver out of the ETFs very privately without going into the open market and creating what the Commitment of Traders report sees and standing for delivery, which is very, very, very visible. And so this is why I hate GLD and SLV. Not only are they, fully custodied by JP Morgan and BlackRock, but the big authorized participants can create these shares and then pull the metal out quietly. And it's kind of like when we saw the price collapse in silver from 120 down to 65. The prospectus says there's a time lag between when they will book the order and then the shares are created. The shares are only created when the bars go in. So they booked the order at $120. The price collapsed, and at the very bottom, 38 million shares
are created,
found their way into, and they're only created when the metal is deposited. Right, so it's almost, did they really buy it in the 60s? But take the orders at 100 plus, knowing it was going to collapse. These are the things that the ETFs allow. If you own an ETF, you're part of the problem. Get out.
The global money supply strongly indicates an astronomical future valuation for precious metals. Financial models assessing the M2 money supply fully backed by gold imply prices reaching $184,000 domestically and soaring to $225,000 when factoring in the expanding economic influence of BRICS nations. Simultaneously, the physical delivery system is facing severe systemic stress. Current commodity exchange data reveals that open interest contracts outnumber available registered physical ounces by a staggering margin, setting the stage for a massive liquidity squeeze. Furthermore, mainstream media narratives deliberately misinterpret historic outflows from major gold ETFs. While reported as retail investors abandoning the metal, these massive withdrawals are actually authorized participants and large financial institutions quietly extracting physical bullion off-market to mask their immense accumulation. Relying on paper derivatives exposes investors to severe counterparty risk while enabling institutional price manipulation. Securing physical assets outside this fractured system remains absolutely critical. Let's get back to the interview.
Bank of America, their lead analyst, their lead precious metals analyst, just came out and said that they see, because of the gold-silver ratio being so far askew, that they could see silver hitting $300 by the end of this year. And 309, I think, was the number. The guy's their lead precious metals guy, and he says that in the light that he sees gold going much higher, and historically silver will have to come along for it, and will probably slingshot the way that it typically does. He's basically saying that he sees silver going much higher in the face of higher gold, which would present an opportunity probably to capture that gold silver ratio. But to your point, Kevin, I wouldn't start really thinking about it until it's in its 50s, and I would only do some of it. I think that's wise. 8 Western banks, some in Europe, some in Canada, some in here, United States, they would short the paper price in New York where the price is calculated, where it's affected. If you dump paper on New York, on COMEX, the price goes down. It's really the only place where price is actually set. So they would short the paper price in New York, driving the price down, and then take a corresponding long position in London, primarily on paper. And they would trade back and forth, they being the US, like let's say it's JP Morgan and Deutsche Bank. They would go back and forth with one another in paper called warrants. You own it, I own it. I'll buy it from you, you buy it from me. And they exchange money back and forth. And the gold would be shifted from their account inside the LBMA to JP's account, back to Deutsche Bank. And it really would never move. Once in a while, less than 1% of these contracts would stand for delivery, send it back. And so more or less, not a whole lot of gold flowed like we're seeing now into the COMEX. It would have just largely been in the form of paper warrants unless there was a little bit of delivery for whatever reason, legitimate reasons. And so they would do this in concert with one another to suppress the price. For gold, it's Gibson's paradox, the inverse relationship of real interest rates and the price of gold. We want the West to seem strong. Our bond market, their bond market, Germany, UK, France, here, all over. Their currency seems strong. The euro, this was done in concert for the West to rule the world, my beliefs, whether it be military or with currencies and with bond markets. Less than 1% ever stood for delivery. So Trump comes aboard, and I think he got to the banks and said, look at all the inflows that we've seen for 16 straight months, unabated, month over month over month over month, unabated. I think he went to the banks and said, now here's supposition. This is my guess. You guys are all idiots. It's an existential threat to this country, to you, that you are shorting all of this, and you need to bring it home now. And here's what you're going to do. You're going to tell them that it's tariffs. You call up your buddy at Deutsche Bank. Listen, this guy's insane. This guy, Trump, he's crazy. Looks like he's going to put tariffs on us. You got to ship that stuff back. We got to cover. We got to cover everything up. Don't worry. It's only a one-way deal. We'll all end up coming back. But just go ahead and send it back. We got to cover for now. And all that metal came back largely. And then the Economic Times says that JP Morgan has flipped to long, along with the majority, if not all, the banks in the United States. So all that metal came back. Where did it go? Where's it leaving to? Did he then say it will then be sold to the Exchange Stabilization Fund to cover your positions and to make us to build our stockpile? Because why is it leaving? Not all of it, but a lot of it is leaving. Where's it going? Who bought it in the first place? Is it simply to cover? So you would cover the West, the banks in the United States, and then you would sell it to the Exchange Stabilization Fund, killing two birds with one stone, leaving who on the hook? Your friends in Europe. What did Tom Luongo talk about? For the longest time, he thinks that this is something Trump is doing intentionally because he believes the European aristocrats are involved with. Now, this is his theory, not mine, but it's compelling when you see Trump start to go after the UK and go after all of these countries in Europe, saying you don't pay your fair share, you're not holding up your end of the bargain, you're not doing what you're supposed to do. The theory that Luongo has is that he's doing it not only to reshore all the metal, but to leave the banks in Europe and in Canada exposed. What did we see when silver, that week when right before silver fell, TD Bank said, oh yeah, tell all their people silver's going to $40.
That was a quick short.
Yeah, and they got stopped out at 92.
Yeah.
Well, it's the banks in Canada and the banks in Europe that have the massive shorts. And if the Economic Times is right, then the Commitment of Traders largely validates this. They're not completely long. They're more long than short. Anyways, the way that it works is, I believe, at least to get the majority of it here to begin with, it was the threat of tariffs. And even though they really never materialized, that's what it was that I think enabled the banks to get the majority of their metal home in a very quick period of time.
Bank of America's top metals analyst says silver could jump past $300 by the end of the year because of how far the gold-to-silver ratio is from its usual level. This jump is happening as global banking systems shift. For a long time, Western banks kept metal prices low by selling paper contracts. In London, banks would trade paper warrants. Now, large amounts of physical metal are being brought back to the US. This shift is pushed by politics and tariff risks. As US banks leave the paper suppression system, European and Canadian banks are left at risk. They could soon face a major short squeeze. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.